Good morning, everyone, and welcome to the Washington Post Intelligence Weekly Briefing. Every week, we bring together our analysts and thought leaders across sectors to help us go quick and deep on the issues shaping the business and policy landscape. I'm Louisa Savage, editorial director of WP Intelligence, which is a new kind of media built for executives and policymakers who need insight to help them see around the corners of policy and industry trends. Our subscribers receive concise intelligence reports with actionable recommendations across AI and technology, energy and climate, global security, and healthcare. We have a graphics library, exclusive interviews, and these live briefings where we sort out the developments that are changing the landscape for business and policy newsmakers. Today, we're looking at the year ahead for oil and gas in light of several major policy initiatives that are coming out of this administration and legislative decisions that are facing Congress in the year ahead. So we have a number of major issues that we're watching and we'll discuss today. The American oil and gas industries are aiming to grow U.S. production and infrastructure in 2026. There's potential new offshore leasing opportunities, a path forward on permitting reform, and an opportunity to modernize pipeline safety regulations. So these are some of the big topics that we'll be addressing today in our briefing. And to unpack the forces that are shaping the year ahead in oil and gas, and to help decision makers navigate these various currents, we have two experts with us today. Catherine Clay is our WPI lead energy and climate analyst, and she is also the author of a recent report, the 2026 Oil and Gas Lookahead, a bold growth agenda faces hurdles. Welcome, Catherine.
Good morning. Great to be here.
And Kevin Book is co-founder of Clearview Energy Partners, which is an independent research firm where he heads the research team and personally covers geopolitics and fossil energy policy. Welcome, Kevin.
Great to be here. Thanks for having.
Well, thank you so much for joining us to unpack some of these big trends in oil and gas. We're clearly in a moment in which American oil and gas industries want to grow. They see a path to grow, thanks in part to several major policy initiatives that are brewing, the potential new offshore leasing opportunities, permitting reform opportunities, and modernized pipeline safety regulations. So we're going to talk about all of these, and the way we'll organize our conversation for the next hour is first we'll talk about offshore leasing, then we'll talk about pipeline safety regulations, and also about LNG, which is a topic we've received a number of audience questions about. And third, we'll discuss what lies ahead for permitting reform, something that's been on the table for quite some time, but can't seem to get over the line in Congress. And as always, we'll discuss how business leaders and policymakers should be navigating this moment. So I'd like to thank our audience for all the questions you sent in ahead of the briefing, and we've used them to help shape our conversation. And throughout the conversation, I invite you to drop your questions and comments into the Q&A, and we'll take relevant questions as we go along. And we'll reserve extra time if we need it. So thank you for that, and let's get into it, Catherine. Let's start with the big picture. We're in a midterm election year, and everyone's talking about the big A word, affordability. Maybe just set the stage for us for how that translates into the oil and gas conversation this year.
Great. Well, thank you, Louisa. That's absolutely right. The affordability issue is framing every discussion that we have about energy policy. When I took on the topic for this report, the outlook for 2026 for oil and gas, I was really spoiled for choice as I talked to different experts in the field because there are so many issues that are going on now. We talked about LNG exports. There's the options for connecting the Northeast with greater pipeline coverage. But I ultimately chose the three that we reported on because I wanted something representative of production, of building our infrastructure, and then of maintaining our infrastructure. And again, the common theme that goes throughout all of those is what is the impact to the consumer? At the end of the day, politicians are very aware on both sides of the aisle that affordability is going to be the name of the game for the midterms. And both sides are positioning their policies within energy as being a pathway to bring consumer costs down. And there's some grain of truth to all of these arguments. Let's take offshore leasing, for example. It is true that as you have more supply, and that can be held up by more US production, held up in the sense of buoyed up. At the same time, it takes years for oil and gas companies to go through the leasing process, the permitting process, and then actual production. So by the time that oil and gas for the leases that are being on offer in this latest round, by the time that the oil and gas production actually occurs, it will be perhaps the better part of a decade before that oil or gas actually hits the market. When you talk about building out infrastructure, I actually think that's the case where you have the strongest argument that it makes a difference for consumer pocketbooks. And the Northeast is a great example of that. It's had notoriously high prices for natural gas because there are bottlenecks in the infrastructure. And if we could get past the permitting hurdles and build infrastructure more quickly, that would have an impact on energy bills at the end of the day.
And I don't think we can leave the topic of affordability without mentioning arguments around renewables, right? There's a lot of people saying, well, if you really want affordability, just bring on more solar, but that also implies infrastructure building as well, I gather.
Yeah, that's true. And they also have permitting issues as well. So both clean energy industry representatives and traditional oil and gas representatives all agree that we need permitting reform and that would, in the end of the day, bring energy costs down. I think though that it's a mistake to think in today's electricity markets to think of oil and gas as being an alternative or a competitor to solar and wind and batteries. The truth is that with the extraordinary growth in demand that we've got in the electric sector, we're going to need natural gas, solar, wind. Solar was the number one category of energy installation that was added to the grid last year. I think that a few years ago, we all would have anticipated, had we known what kind of number solar would be achieving, we would have anticipated that that had to mean it was coming out of the market for natural gas. And instead, what we've seen is that the demand for electricity has grown so much, so quickly, that we really need an all of the above approach. And so it's not instead of, but it's also and.
Kevin, going back to the question of oil and gas and the question of consumer prices and affordability, which we're going to hear about so much this year. In your view, what are the factors that will have the most impact on oil and gas prices that consumers find themselves paying in this year ahead?
Well, we interact with oil as a product of oil through refining. We think of purchasing gasoline as our principal relationship with oil at a consumer level. And so there's always two things that factor into the cost of gasoline. One of them is the price of oil itself, which is in the US the principal constituent of gasoline costs. And the second is the availability and constraints, if they exist, on refining that oil. And sometimes outages can lead to spikes in prices. There are other factors as well: taxes, the costs of additives to the gasoline, the use of oxygenates like ethanol in gasoline can increase prices as well. When we look at the gasoline price right now, you can think on an absolute basis, well, it's a little below $3 a gallon in a lot of areas around here in the district. But as a share of disposable personal income per capita, it's actually quite low. And so on a real DPI basis, we're looking at gasoline not only at levels approaching some of the troughs during the COVID pandemic, when demand collapsed and prices pancaked, but also, if you think about it, we're looking at gasoline disinflationary as a component of CPI inflation. It's offsetting some of the other costs. Now, Louisa, you mentioned oil and gas, and I think when we think about upstream production, supply in the U.S. of both oil and gas into the world are big factors for the price of oil and gas in the world. And both commodities price globally, oil much more so than natural gas here in the United States. And in that respect, U.S. production has an indirect but important impact on that price of gasoline that we buy, which is that about 80% of the additions to global consumption over the last 15 years or so have come from US additions to supply. The US has been such a prolific addition to global oil production, global liquids production, that it has really put a lid not only on prices, but also on price volatility, which is very important to consumers.
Kevin, before we move on from this question, when you talk about prices for for oil being almost at the levels we saw during the COVID pandemic where nobody was going anywhere, what is driving that? Is that a glut of supply from other producers or a reduction in demand or something else?
Well, to put some numbers to it, in the latest month that we've looked at on a rolling 12-month basis, the disposable income share from gasoline, we're estimating, is at about 1.6% of DPI per capita, which is quite low. It was at about 3.2% at the peak of the Ukraine war conflict in the early part of June 2022. So roughly half that. It fell below 1% at the absolute trough of the pandemic. And on a rolling basis, it got down into the low 1% range. Historically, it's been in the 2 to 3 range for a lot of the last couple of decades. So we're looking at a ratio, not the absolute price of gasoline, but again, what it consumes of the American wallet, of the American pocketbook. And the supply side is really the big part of the story. Demand is relatively flat to even slightly up on gasoline consumption, particularly compared to COVID, where we've rebounded back to driving more, albeit not quite as much as we had earlier in previous decades. And also the supply side has been affected not only from prolific production in the Western Hemisphere, the US, Guyana, Brazil, but also OPEC Plus adding back supply to an already long market has really put a weight on prices. So the Brent crude price, the global oil price, has fallen from roughly $80 a barrel a year ago to about $65 a barrel now. And before recent onset of Iran risk, it actually was closer to $60 a barrel.
That's really an interesting reality check. So, Catherine, given all that, let's move on to your Lookahead report. And the first policy initiative that you took a look at was offshore leasing. So, give us an explanation of what is the administration doing about offshore leasing?
Right. Well, this is really quite a significant policy initiative that the Trump administration is laying out. They're actually breaking with a long-held tradition of developing new offshore leasing plans on a rolling 5-year basis. So they actually had a plan in place that was extending forward for a couple more years under the Biden administration that had been proposed. And the Trump administration decided, perhaps not surprisingly, to scrap that plan, which only would have offered 3 areas for offshore leasing in that 5-year period. And they've replaced it with a quite extraordinarily ambitious plan. This plan would offer offshore leasing opportunities to oil and gas companies in almost every segment along the Gulf states and along the Pacific, and extending for the first time up into the Arctic around Alaska. In fact, it's by far the largest number of leases that have ever been proposed to be included in a single 5-year period, something more than like the last 4 or 5 combined. And that's an interesting question about, while the oil and gas industry has publicly been very supportive, is this really something that they would want? Because it is perhaps not as efficient, or whether in terms of production or economic efficiency, to have so many leases on offer at the same time, more than would realistically be developed. And even though they're staggered, there's a schedule for offering them, it's still an enormous amount of potential production opportunity. And there's a limit to how much production and how much leasing there's an appetite for in the market. So there's a higher level question about how realistic is it that all of this tremendous offering would be taken advantage of if it were to go forward. And that is the next question. Will it go forward? Because there's a lot of controversy.
Well, before we get to the controversy, I just wanted to share a chart that was in your report where you looked at some historical comparisons. Can you just walk us through what we're looking at here?
Yes, exactly. Here you can see the regular cadence of the traditional Department of Interior leasing proposals. So they march along in a fairly straightforward every 5 years, maybe a couple variations from that, but pretty much a regular cadence. And the Biden plan has been withdrawn, so that leaves us with a lot of questions, and that's what the current debate is about whether the Trump administration will make this major mark on oil and gas leasing that would certainly have repercussions for years to come. And I think that this graph here, if I could just highlight a couple things for our viewers. So the color coding gives you a sense of where those leases would occur, what part of the country, so which coast, and whether they're in the Gulf or in the Arctic. And so you can see that you can see the relative weighting between those, and you can see that Alaska is, and that includes the new areas in the Arctic, would be a large proportion of that. You can see the Atlantic, interestingly, was withdrawn. That was due to some political decision making or compromise with some of the governors, especially of the Carolinas. So I think that what this really says to me is the administration does mean it. They would like to see more production, but they also want to send a very clear message. They want to do something that it's highly, even if it's symbolic, it's a very powerful message about their priorities, and that is largely about oil and gas production.
Kevin, Catherine mentioned opposition and controversy, and in her report, she talked about opposition in Florida and California. Can you talk about some of the obstacles that this plan faces and whether or not they could materially impact the timeline or the outcome of these leases?
Sure, Louis. So there's 2 points I think I would start with. First is the importance of the Gulf and its place in our portfolio of supply. It's 2 million barrels per day of the more than 13.5 million barrels per day we produced last year. That makes it a very significant part of the energy security story here at home. The second is the importance of the 5-year plan. Right now, the Big Beautiful Bill Act included 15 years of twice annual lease sales in the U.S. Gulf, but that is a law that could be changed. We have moved from an era where regulatory pendulum swings have gone back and forth to the point where it seems like maybe the pendulum is going to come off the clock entirely. And now the laws themselves, not just the rules, but the laws underlying those rules are changing. Going from the Inflation Reduction Act to the Big Beautiful Bill Act shows just sort of the degree of volatility. A 5-year plan that goes through the full process under the Outer Continental Shelf Lands Act ultimately has more durability in this politically volatile time, and therefore would give, I think, greater confidence to people planning programs of investment. And that takes me, I think, to your question and also the controversy. A lot of the companies involved are thinking about programs of investment. Where is existing infrastructure? Where is related and supporting infrastructure? There's several things that they don't want to put money into. A lease, after all, is an option, not an obligation to produce, to invest. Those companies will exercise those options when the market calls. So if the terms are good on the leases, then they have options available to them when the market looks short and it's time to put money to work. One thing they don't want to do is they don't want to fight adjacent states. It's awfully hard to do business in waters off the coast of a state that doesn't want you there. It's not necessarily impossible. There's floating production units that you could use, but the idea of doing that, raising the cost of already high cost production, albeit production with a long tail, and then therefore opportunity for payback, that takes you down a road you don't want to go. And that goes to where I think the sort of the novel approach the Trump administration the first time around explored. They were looking at a provision of the Outer Continental Shelf Lands Act, Section 12A, if you want to get wonky, that has essentially a process for withdrawing parts of the Outer Continental Shelf from the leasing program, but no real process for reinstating it. And so it was an assertion made by the environmental community that if you withdrew it, you couldn't put it back. The Trump administration said, well, we're going to put it back in the plan. We're going to offer parts that the Obama administration withdrew. It went to court. The district court judge in Alaska essentially said, no, this isn't legal. We can't proceed. And the jurisprudence never finished. The leasing plan never finished. And so this goes back to the importance of the plan. If they make a really big, ambitious reach for areas that have been withdrawn and try to put them back in, not only are you running into the operational political risk of governors who might oppose the production adjacent to their states, but now you're running into the legal risk that could come from the plan itself not being valid.
Mm-hmm. And Catherine, you talked a little bit about various legal issues as well in your report. Do you have any others that you want to flag?
Yeah, I'd love to follow on one of the points that Kevin made about the fact that there are leases, the offshore leasing and the Outer Continental Shelf that were included in the One Big Beautiful Bill. Those are in addition to the ones that you see on that chart that you just shared a moment ago, Louisa, from my report. And interestingly, for those potential leases, or those actually, they're in law now, so that they are going to be able to put those on offer. The administration's position has been that because they are mandated by Congress now, they are in law, that they no longer are obliged to have a NEPA review, an environmental review that is typically required for all major government actions. To me, this again goes to Kevin's point about legal uncertainty, and that is the last thing that an oil and gas company wants to take on in a potential development, is uncertainty on that scale. So I think it was a very strong move by the administration, a very assertive move that they are displeased with NEPA and those regulations. But to my mind, it almost certainly will guarantee that there will be legal challenges to those leases if they do in fact go forward without NEPA review.
Mm-hmm. One question that we've had a few audience members send in ahead of our briefing had to do with LNG. And since we were talking about the Arctic, maybe I could ask you, Kevin, about Alaska and this proposed U.S.-Japan pipeline there, and also just how you're seeing the overall outlook for LNG and exports.
Well, there's a lot in that question, Louis, so I'll do my best to try to treat it succinctly. The North Slope gas resource is immense, and it's been stranded for decades. The question is how to get it to market. At one point, policymakers here in Washington explored building a pipeline into the lower 48. Now the approach that's been undertaken with support from the state of Alaska is to build a pipeline to water, liquefy the gas, and ship it to proximate markets in Asia. The growth of LNG demand in Asia is going to be significant by any reasonable projection. There's a lot of need for the net import reliant economies, Japan, Korea, China for that matter, to take in gas from the nearest geographic source, reducing the cost. There's a big business case to be made from a proximity perspective. The challenge is the cost associated with the project, the capital intensity of the project, the challenge of building a project in a very difficult terrain, the frost, the seasonal variation, and the details that you have to go into engineering it. So what the Trump administration has done is they've really elevated this project, the Alaska LNG project, as one of their goals. It's separate gas to the extent that it doesn't really have connectivity to the U.S. It is not only stranded, there's no question of contention for end-use sectors between that gas and other gas, although I think, frankly, the issue of contention is overstated, and maybe we'll get to that. So the question is how to pay for it. And the administration has proposed that the money that the U.S.-Japan trade bargain will deliver to the U.S. for investment could provide some source of capital for that purpose. You have to sign agreements. You have to get those agreements established to be able to finance most projects. If you can find an alternative source of financing that's more agnostic to the risks associated with highly capital-intensive projects, you might be able to get it built. It's a long lead time. It's a lot of money. There are many people who are skeptical about its prospects even now.
And I think you answered my question. It sounds like there is a lot of demand for LNG exports. Do you think that this is going to be sort of a growing piece of the oil and gas story in the U.S.? And if so, is that going to affect, how does that affect gas availability and prices in the United States?
Well, yeah, I think it's already clearly demand is growing fast. One of the things that's likely to make it grow even faster, frankly, is that it looks like supply is going to get ahead of demand globally for LNG in the next several years. That could bring the price down, increase the attractiveness of LNG as a resource, and then, of course, supply can come in to support it. Now, the question of contention for end-use sectors came up at the very beginning of Lower 48 LNG development. The question was, what does it mean to connect essentially the island of U.S. gas prices to the global market? And I think intuitively, all the people who looked at it, all the analysts who modeled it, assumed that there was going to be some increase in cost, but the question was how much and how soon and for how long. And most of the estimates are surprisingly little. The EIA itself, when it looks ahead at the potential impacts in costs for end-use sectors here in the U.S., says, well, this is under $1 per million BTU, maybe even much less than that. Maybe we're down to pennies, depending on the scenario. This is predicated on a couple of things. First of all, there is a lot of gas in the United States. But second, equally important, there has to be a lot of infrastructure to connect the source of that gas to the demand centers where that gas is used. LNG was blamed for price increases in the years after COVID. I'm not sure that was entirely fair. What really was happening was that essentially demand woke up before supply did. During the price downturn, production ground to a halt. Producers had to scavenge for money. They stripped their rigs for parts. Getting back to work, getting the supply back into the market was a lot harder and a lot slower than it was for the market to wake up and to demand gas. Inventories drew down because LNG is a relatively inflexible, not completely inflexible, but relatively inflexible source of demand. And now we're looking at demand on the grid from data centers that could also be relatively inflexible. That's raised a lot of concerns, but there is a very flat supply curve for gas here in the United States. With the infrastructure built to connect those supply sources to demand centers, I think that there was probably a lot of room in our supply stack to support many of our demand needs, all of them.
Great. Well, we'll definitely talk about the infrastructure issue in a minute, but I just wanted to spend a moment talking about pipelines, Catherine. You wrote that there has been a period of regulatory uncertainty that oil and gas companies are anxious to resolve, and that's around pipeline safety. So can you kind of explain what's happening this year in that regard and what it could mean for the industry?
Yeah, certainly. This is one of the issues to watch on the side of caring for, maintaining the infrastructure that we have. So it is a high priority for groups like the Liquid Energy Pipeline Association, the American Gas Association, others. And the issue right now is that the authorization for the agency that has oversight of pipeline safety, which is the Pipeline and Hazardous Material Safety Agency, PHMSA, they have actually not had this side of their work authorized. That authorization expired in 2023. Now, because the way that that agency is funded is primarily through user fees, it's not essentially a make or break thing, that they're able to go forward, they're able to still do enforcement, that they're able to do things that were authorized under the previous round. And typically we have about a 4-year cycle for reauthorization for pipeline safety, and we're a little bit behind on that cycle now. When I spoke to offices on Capitol Hill that were involved in this, they were optimistic that we would see a resolution and that we would get the bill passed. It's the Pipeline Safety Act in the Senate and the Pipes Act in the House. It's stuck in conference. It's stuck with some kind of disagreements on the scope of the bill, the scope of authorization, and the level of enforcement. But I think that it's quite likely that that bill will reach the finish line during this Congress, which means before Congress goes out at the end of the year. But in the interim, industry really would like to get this put to bed and have some certainty.
Mm-hmm. I want to remind our audience to please submit your questions so we have time to get to them. But and we'll move to permitting reform in a moment. But I just wanted to follow up, Catherine. You had said in your report that the industry says that some of the core pipeline safety requirements are based on very old technological assumptions, some that are 20 years old, and that a great deal has changed since then. Can you sort of explain that and how that feeds into this legislation?
Yeah, so I'm going to try not to slide into my complete techie nerddom, but I do love that aspect of this issue. And there are, in truth, some really exciting technologies that have emerged over the last 20 years that can maintain a healthy, kind of ongoing surveillance program of the health and wellness of our pipeline system. So, in fact, I think a medical analogy is not a bad one. So there are technologies that can, in a non-invasive way, use infrared detectors, can use uh, ultrasonic waves to detect corrosion before it's evident to the naked eye, maybe corrosion while it's inside, where it's completely obscured from anything a physical human inspector would be able to see. And the concept is that you can layer these different technologies and these different ways of sensing leaks and corrosion or other problems with the pipeline before they become actual sizable leaks or real problems. And I think the analogy is it's almost like wearables for us. We have
I
that
thought you were going to
potential to
say it's
do
like
more.
colonoscopies. That was the analogy that I was worried about.
That's where your mind went,
And a
Lisa.
tube down those prick lines. Yeah. Okay. Great.
Well,
Right.
actually, okay,
Wearables.
so I think
That
a
sounds
better
more pleasant.
way. Yeah, I think, and I think, just, to keep us on, I think a more, again, more pleasant medical analogy. I think, they do have these very high tech units. They're called pigs for historical reasons of the way that the device used to sound going through the pipeline. In the old days, it squealed like a pig. Now they are nothing like that. They are very, very high tech. And when they send one of these units through, could be miles of pipeline, collecting data, I think of it more as a high-tech CT scan. It's like, instead of you and you're
Mhm.
having your body sent through the CT, it's the machine is actually inside the pipeline and doing the CT scan from the inside of the pipeline. So the argument that the industry makes is, look, we have not rewritten the rules to recognize how much of this ongoing maintenance and ongoing testing we are doing. And we've actually got the ability to change the way that we monitor the health and safety of the pipelines, and we should reflect that in the way that the enforcement rules are written. It's more about ongoing health and maintenance and less about stopping operations and doing enforcement. And that's a center of contention. There are some groups that are not as excited about that. They want to see more data. They're concerned that the industry is perhaps simply trying to reduce the number of inspections for just convenience. And so that is one of the issues that I think is holding up the conference, is how you find that balance.
Interesting. And then lastly, on this topic, before we move on, um, what about the resourcing, right? It's one thing to set standards or update standards, but someone still has to enforce them. And we've seen across various aspects of the federal government a real rollback of resources. Is that a concern in this case?
Right. I think that regardless of the new technologies, I don't think that there's anyone in industry or outside of it that would argue that those are a complete substitute for enforcement. I think the industry is aligned with the public interest groups in saying that the number one issue for pipelines is safety. And enforcement is a crucial part of that. Enforcement meaning human inspectors. We do know that the offices at PHMSA that were responsible for this were cut back during the DOGE period of the Trump administration. Something like 13% of the workforce was let go. And we have seen a very limited number of enforcements, a real decline in the number of enforcements last year, which of course is the first year of the Trump administration compared to prior years. So I think that's a valid concern that people are flagging. Now, the Trump administration did assess a very large penalty against a pipeline for some violations in January. So it's not that they are not present at all. But I think that to your point, enforcement has to happen. It's not going to be replaced by technology. And the question is, how do we get the right balance of the amount of enforcement? Um, Certainly, the cuts to PHMSA from the outside look troubling, and we'll just have to see if the final bill restores authorization. I think the last thing I'll say on that is that if we know now from experience that just because Congress authorizes something does not necessarily mean the Trump administration is going to enact it. So even if PHMSA gets larger authorizations, the real thing to watch is whether you see new hires at PHMSA.
Sure, absolutely. Before we move to permitting reform, Kevin, we've had a number of questions from the audience, all on LNG. So I'm going to throw a few more to you. One is, how will Canada's LNG capacity affect U.S. LNG prices going forward? And another question is the industry building more LNG ships?
So let's start with the second over the first, because I think it's one of the more compelling policy challenges that lies ahead. One of the priorities the Trump administration has articulated is to restore what they've described as shipbuilding dominance. The problem is that when it comes to LNG tankers, there aren't any that really meet the strict tests of the Jones Act, the more than 100-year-old law that requires vessels to be manufactured, crewed, flagged, and managed by U.S. entities. And so the Trump administration, carrying forward on their shipbuilding dominance agenda, had initially mandated some very strict regulation governing LNG tankers, requiring a certain percentage of volumes to be carried by essentially quasi-Jones Act compliant vessels that simply don't exist. They did modify that proposal somewhat. The standards are still there. What they did is they took away the provision that would have put at risk the licenses for LNG themselves for entities that were non-compliant, that didn't hit the minimum threshold percentage. Now, those standards are still subject to revision, but this is something you see a lot in policy here in Washington. It's not rare. Cross purposes can sometimes create interference patterns with unexpected results. And so the idea of creating a shipbuilding goal that conflicted with the LNG export dominance goal, this sort of thing's happened before in many administrations. Right now, I think they're still working on it and managing those two goals together. In all likelihood, until they come up with an infrastructure to support the capacity to support LNG vessel manufacture here in the United States, and there are plans underway to do that, we're going to be looking at using tankers that were built in other countries for many years. Now, with regard to Canadian LNG, again, the question is what you think the overall supply-demand balance looks like over the long term. The Canadian resource is also quite significant, and they are also proximate to Asian markets. And so the question is, are we looking at complementarity or competition? And there are two schools of thought. And there are some who would say, look, adding supply to the market unlocks that demand that builds a long-term market for everybody. And there are others who say, well, wait a second, there's only so much money chasing sale and purchase agreements right now between the off-takers in those markets and the suppliers here in the United States. There is a contention. I think it's open for debate.
Mm-hmm. Great. Well, let's move on to the big legislative issue on the horizon, which is permitting reform. As we said, I think at the beginning, both the fossil fuel industry, Catherine, and the renewables industry have been saying the country needs to overhaul how slow and cumbersome it is to get approval for new physical infrastructure. Can you just, as a level set, sort of lay out what makes it so slow and cumbersome, and what is there to change?
Oh, there's so much there to unpack. It is our permitting process for major infrastructure, in our context, energy infrastructure, is enormously complex. And part of the reason for that is that there are several authorities of jurisdiction. We've got the federal, we've got the state, and then the localities. And if you're talking about a pipeline, for example, that is going to cross state lines, cross through many, many localities, then that's a lot of voices already. And then looking at the federal government, many different federal agencies are involved in approving that project. So, for example, any pipeline or any structure that passes over a waterway must get approval from the Army Corps of Engineers. Obviously, the Environmental Protection Agency also has to provide oversight. It turns out that even though they're all federal agencies, that in practice, most federal agencies will not conduct simultaneous reviews, and nor will the state or the local levels in many cases. So what that means is that even though that we're assessing the same thing for part of the compliance for the Corps of Engineers and for EPA and maybe for the state environmental agency or a local county overseer, even if they're looking at a lot of the same factors, each one will start at the beginning rather than starting with the input from the other agency and do their own assessment. And we also do them in serial rather than in parallel. So we've got a lot of baked in inefficiencies. And of course, it's a very litigious process. Part of the solution is going to have to be addressing the ability to sue a project almost indefinitely as a delay. So it's a system that's grown up over many years with the intent of good things, of trying to give people a say in your locality, in your backyard, what's happening. And we don't want to lose that, but at the same time, we need to be a country that can build great infrastructure. And permitting reform is figuring out how we can balance those two objectives and get the work done.
Kevin, can you talk us through what are the main proposals that are in play, or the key factors that could be changed this year if there is permitting reform legislation?
Yeah, I mean, I think first I would frame the issue to understand where we are and why this is so relevant, so significant, and so hard. For 4 decades, our energy policy was an energy policy of scarcity, and our psychology was one of scarcity. And we found new challenges in trying to adapt old laws for new purposes as we moved first from scarcity to adequacy and more recently abundance. And so the laws haven't really kept up. What we've seen are these attempts to try to work within existing statutory structures. The National Environmental Policy Act, interpreted one way by one administration and then differently by another. The Clean Water Act and provisions of the Clean Water Act interpreted differently. The broader questions of tort reform, which are inherent to some degree to looking at how you're going to manage the legal processes around adjudicating permits. And so there are 2 kinds of permitting reform that can be pursued. There's the regulatory/executive permitting reform, and then there's the legislative permitting reform. And the legislative permitting reform is really the only thing that industry sees as providing the kind of durability and reliability that they can truly invest in and work from. They're trying to work through and work with the regulatory and executive processes. But one of the things that people who are putting billions of dollars to work want is they want their permits to be durable and resilient to all but certain legal challenges. And so what do you need? And to get to the legislative process, you need, of course, well, first of all, you need a vehicle. This is something that's going to be hard to pass, has been difficult to pass on its own, and is generally ridden on top of a so-called must-pass law. In the Fiscal Responsibility Act in 2023, we saw some of the low-hanging fruit on permitting reform legislated at that time on a debt ceiling measure. And so a catalyst that drives action is another big part of it. And I think one of the things that we could get this year, although hopefully we don't, is a price spike or a supply interruption that galvanizes activity on Capitol Hill and focuses minds and helps some of the entrenched opposition between the Democrats and Republicans on this to sort of come together and agree that they've got to get a deal done. And then you need the votes. And that's also been very hard to get because the members themselves have taken some very strong positions. Senator Sheldon Whitehouse, who's the ranking member on the Environment and Public Works Committee, has basically said he doesn't trust the Trump administration to implement any bargain on which they agree based on the lack of permit certainty from existing renewable projects, particularly offshore wind. And so as a result, there's this unwillingness to necessarily come to the table unless they can secure what they believe are reliable terms, reliable expectations. Does that not leave room for a post-election lame duck deal? Of course it does. But we're looking at the whole host of issues, everything from NEPA to Clean Water Act to essentially how the legal proceedings themselves play out. To get through all of these, you have to get through different jurisdictional barriers as well. So the Environment and Public Works panel has a certain purview, but it doesn't cover everything. It's a different story on the House side where you actually have the environmental and energy policies both anchored within the Energy and Commerce Committee to a greater degree, and the Natural Resources Committee, where Bruce Westerman has been trying to advance and has advanced a permitting reform measure of his own, is covering different parts of the the same picture. So there's a lot to get through, a lot of moving parts, a lot of legislative hurdles, a lot of jurisdictional fiefdoms to overcome, and all of that has to be done within the broader realm of our politics in an election year.
Yeah, absolutely. So no small challenge. You mentioned, Kevin, the possibility that a price spike or some kind of event would focus minds. And Catherine, in your report, you sort of looked at a couple past attempts to overhaul permitting, and you took away a couple lessons. And I'm wondering if you can kind of just share what we can learn from past efforts that either succeeded or failed.
Absolutely. As well, Kevin has laid it out so well. We have been trying for a long time to get permit reform over the finish line. And I think that we'd be remiss if we didn't acknowledge Senator Manchin, who's now retired, and his really valiant efforts to try to get permitting reform that everyone could agree on. And he and Senator Barrasso were leaders and partners in trying to come up with a common cause and a compromise that everyone believed it was common sense and could really make things better and make us more able to build big infrastructure in this country. And, I think it's an interesting question. They were certainly both very well positioned in leadership roles on the right committees and very well respected. There's always this sort of aura with a senator that is retiring. Usually, if they have a signature issue that they want to accomplish before retirement, often you will see that gets a little extra oomph, a little extra support from their fellow senators. So for a while, it looked like Manchin might really be able to deliver that as a legacy. Unfortunately, I think we didn't get where we needed to get. We're still in the same position of doing the work. I think that, as Kevin said, it really is going to take some dramatic kind of external forcing event, something like a shortage or extreme price spikes, something that focuses the voting public to look at their members of Congress and say, what are you doing about this? And that kind of political leverage and public demand is really the only thing that's going to break the impasse.
And Kevin, we have a question maybe that gets a little bit at the substance of what we're talking about when we say permit reform. One of the audience members says, does permitting reform necessarily involve lowering environmental standards? So can you explain maybe what some of the potential substance would look like of reforms?
Yeah, I think it doesn't necessarily require you to lower environmental standards. What it does is it articulates a narrower band of interpretation for what the environmental statutes provide. And so one of the challenges that project developers, particularly for pipelines, have run into is that the Clean Water Act, Section 401 of the Clean Water Act, provides a lot of local control over determining what qualifies for a permit. And the degree to which states can make interpretations of the CWA that are broader than may have been statutorily intended, or maybe not. I mean, again, these things are adjudicated. This is subject to interpretation on both sides. Gives them some leverage over the ultimate approval or disapproval. The idea of NEPA and environmental assessments establishing sort of whether it's a discussion or a decision, I think it's the NEPA process has generally been thought of as a disclosure of environmental risks rather than a decisional gate, but it has functioned in legal proceedings as something of a gating question. Was the NEPA analysis adequate? Was it suitably broad? The studies themselves, the environmental assessments, which are the shorter version, or the environmental impact statements, which are the more thoroughgoing analyses, as Catherine mentioned, involve multiple agencies going through different levels of scrutiny using different processes. How to get that done in a reasonable time frame so that the burden of capital put to the side and accruing costs doesn't overwhelm the economics of a project is part of the question here. It's not to say to get rid of reviews entirely. I think, again, some of the processes that have been explored for expediting approvals could be legally challenged and therefore risky for investors and maybe not as desirable for that reason. A legislative reform process that provides a narrower time frame, a narrower set of parameters. These were essentially some of the goals of the SPEED Act that came out of the House which is currently in contention before the Senate right now.
Mm-hmm. And just to underscore what I think I heard you say earlier, your take on this was unlikely to happen before the midterms, but perhaps something's possible after?
I mean, literally the entirety of the best lobbyists in Washington are mobilized behind this issue right now, trying to move it. So I don't think it's prudent. You wouldn't want to bet against that, given their success and capabilities. But when you look at the intractable nature of what they're up against and how hard it has been for so long, I think the window of opportunity has closed or is closing soon. Let me give you just 2 data points to think about. We had the longest government shutdown in history last year. That's not a sign of a well-functioning bipartisan body handling difficult issues. We also have subnational redistricting going on both sides of the aisle as both parties claw for an opportunity for advantage in those midterm elections. That's not a hospitable environment for trying to manage trade-offs and bargains on deeply felt and long-held battles. So no, I think that there are opportunities, of course, because of those catalysts that Catherine and I both mentioned, unfortunate though they may be. But the most likely scenario is that if you have some sort of change of power event and a last chance for a best bargain, then maybe you'd be looking at a different environment. Or if you have a continuity of power event and a last chance for a best bargain, you might have more opportunity to act in that lame duck session.
Great. Well, Catherine, before we move on, I just want to ask a couple of questions that have come in from the audience about Venezuela. And so I'll just run through it really quickly. And this is something you've written a report about not that long ago. So I'll just put these to you, and then maybe, Kevin, you can weigh in, but we'll keep it really short. Will Venezuelan oil have any material effect on the price of oil? And if so, when and what order of magnitude? Is the consideration of gas supply from Venezuela by American Big Oil eligible to expect, and how far is this possible? And please explain the Venezuelan oil transactions. So maybe just give us your top line take on the situation with Venezuelan oil right now.
Great. Yeah, I'll try to touch on all 3 of those briefly. So the first question about the effect of Venezuelan oil coming onto the market or whether changes there are going to affect U.S. prices. I think, and I'd be interested to hear Kevin's thoughts, I think if at all, very minimally, because we already are in an oversupply situation. So I think that is, we're not going to see massive production ramping up, I think, too quickly, because we are in an oversupply situation, and also because the investment climate in Venezuela is extremely, extremely difficult, as I laid out in my report. So we aren't going to see a rush of investment and quick production coming from Venezuela. So the second question about natural gas. The natural gas that is currently being flared at many of the production sites for PDVSA. I talked to an executive with an engineering firm in Venezuela, and this is one of the things we talked about. And really, the demand in Venezuela for natural gas for electricity production is going to be the #1 priority. So I don't think that it's never say never, but it's really not something anyone's contemplating seriously at all. Is LNG exports. If anything, we would see pipeline exports to neighboring countries. And I think it's really about domestic consumption. And then finally, the chain of extraction to buyer. Well, I could explain how it used to work, but I think that everything is up in the air. It used to be that PDVSA would do partnerships with outside oil and gas companies. But it would be it would have to be at least 50% majority share by PDVSA. PDVSA really called all the shots. Is that going to change now with the U.S. having such a large physical presence and exerting so much influence? Perhaps, but again, that would depend on oil and gas companies from the U.S. and other countries actually deciding to invest in Venezuela.
Does that all sound right to you, Kevin?
It's also great. Yeah, of course. Catherine's on top of it. I think what I would add is just a small color commentary. I think if you ask, well, will this change prices? Adding to global supply intuitively does change prices, assuming demand stays the same. Adding supply would lower them. But getting that addition is a lot harder than it sounds. You have to think about two different tranches of supply growth. One is existing operators expanding their footprints, repairing, upgrading, and improving infrastructure, debottlenecking, and that gets you some incremental hundreds of thousands of barrels per day in best case in the next 12 to 18 months, and then actually trying to realize some of the potential in Venezuela's deep resource bench, which is hundreds of billions of barrels of oil. But that requires tens of billions of dollars, maybe $100 billion of investment over years. That near-term effect, though, does have some relationship to very specific grades of crude. So the Venezuelan oil is heavy and sour. It's similar in character to oil that comes out of Mexico, the Maya grade, and also the West Canada Select grade that comes out of Alberta. And one of the impacts is that you could see a change in the price received by the sellers of those competing grades as more Venezuelan barrels land on American shores. Now, in theory, that doesn't change prices maybe for the end user very much. It could if it produces more end products because these molecules were more suitable for things like diesel and jet fuel, more suitable for certain grades of chemicals. But if you look at what you're getting, you can look at the West Canada price relative to the WTI price. Usually it's been $10 to $15 cheaper. It was about $13 cheaper before the Venezuelan news broke. It's about $15 cheaper now. So you're seeing a modest change, a modest widening of that WTI minus WCS differential, as we would call it. And so there are some signs that you're seeing a very mild price effect.
Gotcha. All right. Well, this has been fascinating. We always in our briefings like to ask our guests what you're working on next. Help us look ahead. Catherine, talk about what you're working on next for our subscribers.
Great. Well, I have a couple things that I'm working on. One is looking deeply at some of the so-called hard to abate industry sectors with respect to greenhouse gas emissions, and in particular steel and cement. The U.S. has some of the most energy efficient and carbon efficient steel and cement sectors in the world. But what does that get them during the Trump administration when that kind of status is not as popular, but they're still moving forward. So it's fascinating to see what they have going on. The other thing I'll mention is I'll be attending NARUC next week. Of course, so much of my reporting has been on electricity and the extraordinary things that are happening in our electricity sector. So I'm looking forward to learning from all of the attendees and the leaders of all of the regulatory utility commissioners that are coming together for that event. So stay tuned to hear more about that.
Excellent. And how about you, Kevin?
Well, the geopolitical dynamism of the moment is doing a lot to keep us quite busy. So everything from Iran to India and in between Russia and Venezuela seem like they're perennial topics we write about every week. In addition to that, I think there are questions about global supply-demand balances. And so staying within the oil and gas conversation, the question about OPEC having added so much supply back, what will they do if the market ends up looking longer than they expected? We've seen them hold pat for a little bit. Will that change in coming months? We'll be watching.
Excellent. Well, thank you so much, Catherine and Kevin, for joining us. This is obviously an issue we'll continue to cover closely at WP Intelligence. And before we wrap, a quick reminder to the audience that you can request a WP Intelligence platform demo by clicking on the link on your screen. And we'll send you a link to a recording of today's briefing. And we'll also send you a short survey that we would appreciate if you give us your thoughts on so that we can continue to improve this experience. And I would invite you to join us next Friday. I'll be here with our lead AI and technology analyst, Jason Dean, and we'll be talking about the future of R&D and the implications of AI and quantum computing for science. And we'll also be discussing the administration's new Genesis initiative. So a lot to unpack there from Jason's recent reporting as well. So thank you all for joining us and have a wonderful weekend, and we'll see you next week.